Hey TMFG community, Carlo Cansino here with John Iaconetti. And in today's Ask TMFG episode, we'll be doing part 2 of 10 investment principles we should be abiding by. If you do like our YouTube channel, please do subscribe, provide us with a like, or comment and give us some feedback. In today's video, John will be completing part 2 of the 10 investment principles that we should be abiding by. John?
Perfect. Thank you, Carlo. So today we're going to get started with the next principle, and that is practicing diversification, and primarily diversification by geography. And as Canadian investors, we're often tied to more towards the Canadian market with companies we're more familiar with, but you're not really in a truly diversified portfolio until you're investing all over the world. And the reason why we diversify this way is to reduce risk as much as possible. The more countries you're going to hold, the less actual risk there is to you because you're not tied to that one country's rules and laws and government and regulations. Now you're tied to the rest of the world and just the overall economy itself. So it does reduce risk, and actually based on the data as well, it actually improves your return as much as we'd like to think Canada is a top performing economic country. There's actually plenty of other countries out there as well that are performing very well. The next financial principle is avoid market timing. And this kind of goes hand in hand as well with the previous one, just with geographic locations. This one is more focused on the actual industries themselves and trying to time what industry is going to be a top performer moving forward. Now, oftentimes, something like the tech industry in the past couple of years had been a hot commodity and something interesting for investors to get involved in. 2022 actually wasn't so profitable for the tech industry in the US. So going back to Carlo's point from our previous video, picking the past winners doesn't necessarily mean you're going to lead to picking the next winner in future years.
Precisely, John. As you can see from the chart shown, it illustrates the different asset classes that are available to be invested in. And you can see over the period of time from 2007 to 2021, there is no pattern. Nope. There is no trend to what sector or what country will outperform. Mm-hmm. For instance, the best performing or the worst performing asset class in 2020 was the best performing asset class in 2021.
That brings us to the next factor, and that's managing your emotions. We're very well in tune with the human side that comes with investing and a potential retirement or hoping that cash flow is available and for you for the next year. When markets are being incredibly volatile, your emotions are going to be volatile as well. So when markets are doing well, you probably go through this elational phase where you feel great about the markets, feel great about your overall investment. Things start trending downwards, you start feeling nervous, and then you enter into that fear territory. We've seen that firsthand with our clients, even for a perfect example, 2020 and 2022. There's been a lot of reasons to invoke fear in the market. The important thing is being steady as you go. Not being too happy when markets are really good and not being too fearful when markets are bad. Markets are going to be volatile, but as long as you're keeping your emotions stable, you'll be a successful investor.
I think the point to take away with that is you need to expect that the market is going to be volatile. Yep. If you can just have that ingrained in your mind when you're in a market-based account, you won't have those highs when the market is very good, and you won't have those lows and feel very emotional because you know that's coming. So we just went through with the global pandemic in March, Yep. We saw the markets drop 35% immediately. People panicked, stayed invested, and the market went up. And so that's what's going to happen. I can guarantee to all of our clients out there that we will see another drop in the market, but we'll also see a subsequent recovery. Yep. So if you can just understand that that's going to happen, it'll be much easier to manage your emotions.
Absolutely. And that last point is going to lead pretty well into our next point of looking beyond the headlines. What does invoke a lot of our fears is the media coverage that goes along hand in hand in times like this. You can read news articles about why the U.S. is going to fail or Canada is going to fail or your portfolio is going to drop. Those articles aren't for your benefit. Those articles are to get a click, to get a like, to get a share, to get people to pay attention to that news outlet.
It's funny, just a couple of weeks ago, we were talking about different headlines and how sometimes good news isn't necessarily good news. It could be bad news. For instance, a month ago or a month and a half ago, the U.S. came out and stated that 500,000 new jobs were created, which typically in a regular market environment or economic environment would be an amazing data point. but not at a point or an environment where they're trying to slow the economy down. Rates have been rising as quickly as they have been to try to bring down inflation and to bring down demand. But when you hear numbers like creating 500,000 new jobs, it sounds like the economy is revving and getting going. So sounds like good news. It's a headline, but don't take that or don't use that in how you're managing your portfolio or become emotional about the news that you've heard.
Yeah, that's exactly it. News is news, and that's about it. Whether it's good or bad, it's just news at the end of the day. And it's not just common to today with the news headlines. We've seen it before. We've seen it back in 2008 and even further beyond that. We actually did a webinar recently, and we looked into headlines around that time in 2008, and a lot of it was discussing, this is the fall of the U.S. economy. They'll never be able to recover. And sure enough, we go on a prolonged bull market run soon after that. So this is not news to us. This is just what we've come to expect with how financial media works. And that leads us into our 10th point. And that's something we're a big proponent of here at the McClelland Financial Group, is focusing on controlling what you can control. And unfortunately for us, the markets are not in our control. What the government does with the interest rate is not in our control. What elections happen are not in our control. What is within our control is how we structure your portfolio, how we focus on avoiding tax as much as possible, how we focus on getting you properly insured, really everything that we can do for you as financial planners. And that's something that you should prioritize for yourself and making sure that you're properly taken care of that way.
Perfect. Thanks, John. So to summarize, the last 5 investment principles we should be abiding by are practicing diversification, spreading the risk around. Number 7, avoiding market timing. Don't get involved in getting out at the wrong time or getting in at the right time. Just stay invested. Number 8, manage your emotions. Don't get too excited at the highs and don't get too low when the market is dropping. Number 9, look beyond those headlines. Don't let the media influence what you're doing with your portfolio. And lastly, focus on what you can control. Don't get inundated by all of the news, Twitter posts, Instagram, TikTok posts.
Yep.
Just stay within your plan and you'll have a much more enjoyable investment journey.
That's exactly it. Avoiding the noise. And we're curious to hear from you. Which one of these 5 do you find most difficult to keep up with? So feel free to put that down in the comment section below. But that's been another episode of Ask TMFG for today. Remember, like, comment, and subscribe to our YouTube channel. But until next time, I'm John Iaconetti.
I'm Carlo Cansino.
And this has been Ask TMFG.